this bid offer spread. So this is a footprint chart. This is the depth of market, whatever you want to label it as. It could be a depth of market. It could be a footprint. Crossing the spread shows something very, very simple. It shows aggressiveness. Shows aggressiveness, and everybody kind of knows that from a multitude of different footprint type courses or classes. There's a passive buy trade, of course, in here. This is where you would be bidding in the limit order book. So you'd bid the limit order book here. This is passive. And that means, of course, that you're in accumulation mode or you're exiting a short position. Generally, the bids are going to be here. And obviously, as the price drops down, you bid more at lower prices and so on and so on. So what happens next? What happens next? Well, once we've accumulated everything, the institution finds that there's nobody willing to sell across the spread, because obviously for me to buy there, the only way I can buy at that price is if there's a seller willing to cross the spreads from above, right? So a seller willing to cross the spread gives me my fill in the limit order book. If the seller gets less and less and less, and the seller stops willing to cross the spread, in other words, the seller moves up into this area here, well, then obviously the only way I'm going to get filled now is if I cross the spread. And this is me crossing the spread. So I am now moving into the top right-hand corner, which is called lifting the offer. So we're now lifting the offer. And obviously that's aggressive. Now, obviously in terms of a simple bid offer spread chart, this is quite useful. But when we're looking at it from a complete market perspective, it still has the same process. So if I look at it from a complete market process, I look at it from this type of process here. See how it's the same thing? It's the same thing. But obviously what happens is we see the price developing inside of this bottom left-hand corner here. And then we see the price moving into the top right-hand corner here. Well, this on a macro scale basis is exactly the same, isn't it, on a micro scale? So what we're doing is, what we're suggesting here is that on a bigger picture, the commercials are now lifting the offer by buying at these higher prices, whereas before they were passively buying at these lower prices here. But once the seller stops selling and the buyer start crossing, that is still crossing into that trade. And obviously the intention of that process is to take the price higher at that stage. So that's when we talk about the commercials crossing the spread. It can be done in one of two ways. It can be done on the footprint chart simply by watching the deltas, because a positive delta is a buyer crossing the spread. But also in terms of market structure, the crossing of a spread can be seen visibly by seeing that little box appearing anywhere on your charts. And it doesn't matter where we look for that box, does it? It doesn't matter what time frame we look for that box. Here's gold, here's the euro dollar on a 1 hour chart. If I was to draw in the box, where would the box be? Well, of course, the box would be and I'll draw it as a diagonal line. There's the box there, right? So we can already recognize where the box is. There's the box. So obviously on the basis that this was a passive accumulation on the bottom left-hand side, when we cross through that box, this becomes a more aggressive buyer at higher prices, which suggests what? It suggests, of course, that the overall shape of this market is destined to be going in which direction? Higher, right? It's destined to be going higher through that process because the buyers are crossing far higher prices to get long into this. And when you're buying at the extremes, we are now expecting, of course, this market to be bullish because the buyers are now paying across the spreads, not necessarily from a footprint chart basis, but from a more active chart basis, a structural basis. The buyers crossing the spread is bullish this market, and we expect higher prices. Does that answer the question about crossing spreads?